Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Disney stock. So let's get started. Today, February 4th, 2020, this company reported earnings. And right now, after hours, we can see the company is down about 0.41%. So it's pretty much flatline. So today we're going to take a look at some articles from Disney Plus and Seeking Alpha, and we're going to take a look at the information they gave us during their presentation. I'm still away from home, as you can see, so I still have no green screen. So excuse the mess in the back, but let's get started. Okay, so Walt Disney reported their quarter 1 earnings today. They did non-GAAP earnings per share of $1.53, which beat by 9 cents. GAAP earnings per share were $1.17, which missed by 8 cents. We see revenue at $20.86 billion, which was a 36.3% year-to-year growth. We still see these big companies producing these double digits growth, and that was a beat by 50 million. 50 million compared to that 20.86 billion. It's not that much, so I wouldn't consider that a huge beat, but a beat is a beat. But yeah, we can see why the company is pretty flat. Earnings per share were okay. With the small beat, and revenue was a small beat as well. So we can see why the shares are pretty flat right now. In the other article we see here in Seeking Alpha, Disney subscribers were 26.5 million, and that's well ahead of expectations. They were expecting somewhere around 20 million. They got about 26.5 million. They also saw growth in ESPN Plus subscribers and in Hulu subscribers, and we're going to take a look at that later on through this episode. The final thing we're going to take a look at is this company's forward PE ratio. This company's forward PE ratio is expected to is somewhere around 22.7. Forward PE ratio for earnings per share of 2021 to be $6.23. We can see growth for this company happening in both earnings per share and revenue for the next 2 years. And that's why we see that forward PE ratio around 22.7. All these big giants that we keep seeing have a closer PE ratio to 25. So 22.7 forward PE ratio is looking pretty good. A pretty okay time to open up position if needed. All right, so now we're going to start looking at the information they released during their earnings. I took the liberty of reading the article and highlighting all the key points, which I'm going to talk about. The first point is diluted earnings per share from continuing operations for the quarter decreased 37% to $1.17 from $1.86 in the prior year quarter. So we're seeing, right, this company, and one thing we know is this company was expected to use a lot of money especially for that Disney Plus launch, and that's one of the main reasons that we can see this earnings per share drop, and that's something we're going to talk about later on in the episode. So now we're going to take a look at revenues. We're going to compare quarter 1 of 2020 compared to quarter 1 of 19, and these are quarters that ended in late December. So revenue for this quarter was 20.8 billion compared to 15.3 billion last year, which was a 36% year growth. We're going to see income from operations before income taxes are about 23% less than same time last year. And we're going to see one of the major reasons was the cost that this company had, mainly on Disney Plus. So last year was 3.4 billion before taxes. This year was 2.6 billion, so about a 23% decrease. Total segment operating income, though, increased about 9%. Last year was 3.6 billion. This year was about $4 billion. Diluted earnings per share, like we mentioned, were 37% lower this year compared to the same time last year. Cash flow from operations, which is my favorite cash flow to take a look at, was down 22%. And again, this operations is mainly due to that Disney Plus launch, and we were expecting to see a less free cash flow and less cash flow from operations. This was 22% less cash from operations and 68% free cash flow. This company still has about $292 million of free cash flow for this quarter compared to 904 a year ago. Next, we're going to break down this company's revenue. So the revenue for this company is as follows. First, we have media networks, and here this is their cable, television, and other cable distribution. all their cable distributions. Next, we have parks, experience, and products. Here you have all their theme parks, all their cruise ships, and any types of products that they have inside these. So if you go to Disney World and you buy food and you buy some form of souvenir, this goes into that revenue. Then you have studio entertainment. Studio entertainment are all the big movies that come out in theater. Then we have direct to consumer. Direct to consumer are all the subscriptions like Hulu, Disney Plus, and ESPN. And then the final is eliminations, and this is just the reduction of items from their previous revenues. So media networks, which is all their cable TV, is up 24% compared to the same time last year. So that's pretty impressive that we still see a huge growth in there. Last year was 5.9 billion. This year is 7.4 billion. Parks, experience, and products is up 8%. Last year was 6.8 billion. Right now is 7.4 billion. So we see an 8% increase. Studio entertainment, which is our movies, are up over 100%. Last year was 1.8 billion. Same time this year was 3.7 billion. And we know one of those biggest was that Star Wars movie that came out. But there were a lot of other big movies that came out during the last quarter one of 2020. Direct to consumer is up again over 100%. And this is, remember, that Disney, Hulu, and Espn. Last year was 0.9 billion. Right now is almost $4 billion. So there we can see, and just as we see that revenue growth, we are seeing the operating income from those segments growing around the same percentage. Media network operating income grew 23%, where revenue grew 24%. Parks and experience grew 9%, where revenue grew 8%. So we see these similar levels, similar percentage growth in operating income compared to that revenue growth. And it's crazy, right? We see that revenue growth across all those platforms in the high double digits, except parks and experience, which are in the high single digits. So now we're going to take a look a little bit closer into each of these revenue segments to see how they're doing. So like we said, media networks is increased by 24% this quarter compared to the same time last year. Operating income increased 23%. So we see that double digit growth. And we can see cable networks grew 20%. And then we have broadcasting that grew 34%. In cable networking, they say the higher operating income was due to the consolidation of 21st Century Fox. So all the new channels they got with this, which was right FX and National Geographic networks, and then it was partially offset by a decrease in ESPN. We can see that ESPN is having less advertisement revenue, and the reason they have less advertisement revenue is because they have less viewers. Next, from broadcasting, one of the main reasons was due to the consolidation of that 21st Century Fox acquisitions. So yeah, we can see right I thought this was pretty impressive that their media networks were up by such high double-digit growth, 20% in cable networks and 34% revenue increase in broadcasting. Next, we're going to take a look at parks, experience, and products. For the quarter is up 8% compared to the same time last year. And the main reason is up is due to the increase at merchandise licensing and domestic parks and resorts, and is partially offset by lower results on their international parks and resorts. So they are seeing a lot more growth in their domestic parks. So here in the United States, they have a lot more sales on their merchandise licensing and the parks and resorts. And international, it seems to be slowing down compared to here in the United States. The higher merchandising were due to increase of revenue from the newer movies, right? Frozen just came out, Star Wars, Toy Story, and it was partially offset by lower merchandise based on Mickey and Minnie. So this is pretty crazy, right? So Disney, the main company, their main characters are Mickey and Minnie, are selling less products than their newer product characters, right? So Frozen, Star Wars, and Toy Story are selling more than Mickey and Minnie are growing, opposed to Mickey and Minnie actually decreasing. They also say that the growth in the domestic parks was due to higher guest spending, and they also see an increase in attendance, but not as much. The higher cost spending was due to increasing of average ticket price and the increase in food, and people are spending more on beverages and merchandises. that there were higher costs to this sector. We're going to see the cost of these were increased by, they have new guest offerings, so they're trying to get new guests to come in by doing some form of promotions, which increase the cost of revenue. And they also, with the impact of wage increases for their union employees, so they are paying their employees more now, which also increased the cost for this revenue. They do mention that international parks are doing a little slower than intended. Hong Kong specifically has gone down, but they are growing in Shanghai Disney resorts. They do say that the Hong Kong resorts was due to the decrease in attendance in both park and rooms, and they are saying this is the impact of recent events. We know in Hong Kong, right, there are a lot of protests going on, and in Shanghai for this quarter, this was before the coronavirus actually became major news. So we are definitely going to end up seeing lower revenue, especially in international parks, due to this whole coronavirus incidents happening around the China and Asia region. Next, we're going to take a look at studio and entertainment. Here we saw over 100% growth in it, and it was mainly due to the main movies that came out this year, right? They have Frozen 2 and Star Wars, some big breadwinners for the movie industry, compared to the same time last year where they only had Ralph Breaks the Internet, which it's not as big as any of these other companies, as any of these other movies. They also had Mary Poppins, again, nowhere near the size of Frozen 2 and Star Wars. They also had some other movies, but nowhere near the type of audience base as Frozen 2 and the Star Wars franchise. So we can see that's the main reason why the studio entertainment was so large this quarter. Next, we're going to take a look at direct to consumer international. And again, this increased by over 100%. Just revenue went from 0.9 billion to $4 billion. So about a 4-time increase in compared to the same time last year. Operating loss, they did not incur any income from here. They had a loss on operations from 136 million last year to 693, and they are saying that this cost was due to the launch of Disney Plus, and they also have higher loss at ESPN, and we're going to take see a reason why. In ESPN, they had the loss due to higher costs to obtain stuff. So the UFC rights had a higher cost this year compared to the same time last year, and they also are spending more on marketing spending for ESPN Plus, but it was offset by subscriber revenue growth and UFC pay-per-view fees. So now let's take a look at subscribers for this company. So Disney Plus last year had no subscribers, right? Because it only came out in November. It came out in quarter 1, and right now it's sitting at 26.5 million users. That's insane. This Netflix, I think, has about 160 million users in the United States, maybe closer to 170 in the United States, but look, 26.5 in just the first quarter. ESPN last year had 1.4 million. This year has 6.6. So we can see that heavy growth there. Hulu went from 22.8 last year to 30.4 million users, and increased by 33%. So again, and then Hulu's broken up into two different things: live TV, which is more like a cable cutting, and then they have the single viewing with advertisements and stuff like that. And that one grew 29%. Live TV grew 88%. Next, we're going to take a look at the average cost per subscriber. The average cost for Disney Plus subscriber is about $5.50. The main reason this is down, right, is Disney Plus has a lot of specials going on. That, hey, if you have Verizon, you get it for free for the next year and stuff like that. We have ESPN. Their average price went from $4.67 last year to $4.44 this year, a decrease by 5%. And for Hulu, for the low membership, it saw a decrease of 9%. For the high membership, the one that's the cord cutting, went up 14%. They do mention that the main reason that ESPN and Hulu went down, Hulu, the cheap version, 5% on ESPN decreased, and 9% on Hulu, the cheap version, was because there is that package with Disney Plus, and when you buy it all through that package, they are it costs less than just buying them individually. So that's the main reason these packages, these average prices have gone down compared to the same time last year. All right, so that's all from there. Now let's just take a look at this company's income statement. In the income statement, revenues, we already talked a lot, but just for one more time, this company this year sitting at 20.8 billion of revenue compared to 15.3 billion last year. That's an increase of about 5.5 billion in revenues. Unfortunately, cost of expense increased by about $7 billion. So revenue increased by 5.5, cost of expense actually increased by about 7 billion. So we see cost of expense grew at a faster number wise compared to revenues, and that's why we see a lower earnings per share this year compared to the same time last year. Cost of expense last year was 11.8, right now is 18 billion dollars. Some other expenses they had, restructuring expense was 150 million this year compared to 0 last year, and then they paid a little bit more on interest expense this year compared to the same time last year. So right at the end of the day, net income this quarter was a little bit lower than same time last quarter. Net income was 20.1 billion this quarter compared to the same time last year of 20.8 billion. Next, the only other thing from the income statement that I really want to talk about is this company's diluted shares. This company's diluted share has increased by 400 million, and that's a lot. That's probably due to some form of stock premonition, stock bonus to their employees, their CEOs, and all that. But seeing a 400 million increase of diluted earnings has increased, right? Last year was close to 1.5 billion shares, where right now is at 1.8 billion shares. So actually about a 300 million increase. All right, next we're going to take a look at this company's balance sheet. In this balance sheet, right, if you guys have been watching me, balance sheets are my favorite ones to take a look at because it actually tells you how the company's doing. The first thing is cash and cash equivalents grew by about 1.4 billion. That's a nice amount of extra cash this company has. Receivables also grew, but when you're producing more revenues, you would expect that to increase. So that's not that big of a deal. Inventories are pretty flat. Licensing content costs and advances are lower this year compared to the same time last year. And again, these are assets that current assets usually fluctuate a lot, right? Because especially everything outside cash and cash equivalents. So usually receivables, inventories, and this like licensed content costs and update and advances usually fluctuate a lot throughout the quarter because it all depends on when they receive the payments from their customers. So if the customer has not paid yet, you might see something like last quarter where you have higher assets in licensed content costs. But when these customer has paid off already, you see a lot lower. So the current assets usually fluctuate with inside. What you really should take a look at is the total current assets as a whole, and we can see they're pretty much flatline. Last year was 28.1 billion. Right now is 27.8 billion. So a decrease of about $300 million, which is not that much for total current assets. Next, we're just going to take a look at total assets. Total assets increased about 7 million this year compared to same time last year. So same time last year was $194 billion in total assets. This year was $201 billion. And here there were no real big jumps anywhere except other assets. Other assets grew by about $4 billion, but everything else grew a little bit by little bit that ended up increasing this by that $7 billion. Finally, let's take a look at this company's liability, current liabilities and total liabilities. First, let's just take a look at total current liabilities. Total current liabilities grew by about $3 billion. Last year was 31.3 billion. This quarter is 34.7 billion. So an increase of about $3.4 billion in total current liabilities. We see the big jumps were in accounts payable. But again, it makes sense. This company had more revenue. So if it had more revenues, it had more items to sell. So it bought more from its suppliers. So you usually would see when you see an increase in revenue, you also usually see an increase in accounts payable. Current portion of borrowing, that's just how much money is left. It needs to be paid off this company has in bills this quarter. This one fluctuates. It just depends when the loan is due, and how much of it is due. So that's why you see that increase of about $1.2 billion in there. Again, nothing crazy here. There's nothing to really be alarmed here. Deferred revenue, this company has a little bit more deferred revenue this quarter compared to the same time last quarter by about 300 million. And to me, deferred revenue should actually not be, I don't consider it a total current liabilities. This is just revenue this company has collected, and it needs to provide the items for it. So eventually this goes to the asset sheet, which this company is definitely going to deliver. Next, we're just going to take a look at long-term debt. This company's long-term debt has decreased by very little amount, 59 billion. This company right now he's borrowing about 30.1 billion dollars of long-term debt. That's actually pretty high for me. One thing I don't like is how high that long-term debt is compared to this company's cash and cash equivalents. One thing I've been seeing is all the other big companies have enough cash and cash equivalents to pay off the company's total borrowings. But then the other companies, right, when I start to think of it, the other companies don't have theme parks the size of cities, right? I mean, it might be super expensive. They just opened up that Shanghai theme park. They have the Hong Kong theme park. They have all these other theme parks that those alone probably took so much money to get started. So it is understandable why this company has such large borrowings compared to other giants, because they don't have the products that this company has, right? Imagine having land the size of cities for theme parks. So that to me, again, it seems understandable. One thing I do like is that total current liabilities is very similar to total current assets. Total current liabilities is a little bit higher, but not that much difference. And this company is providing some form of positive cash flow. Next, the only one I want to take a look at is cash flow from operations. Cash flow from operations is about $400 million less this year compared to the same time last year. But one thing is, this company had a lot more expenses this year, especially because of the launch of Disney Plus. So that's it. That's all I have for you guys. Let me know what you guys think, and let's just do a quick recap of what I think about Disney. So with Disney, we see a growth in all their revenue segments, which is pretty impressive. I did not think I would see a revenue growth in their cable revenue segment, but we did. We see subscriber growth all around the parks, increase in Hulu, in ESPN Plus, and Disney Plus. And yes, we did see that decrease in average price for those items, but that's just because of that bundle item. This company is collecting more revenue if they compared to if they were individually, right? Because maybe some people might only buy Hulu and not need the other ones, but with the bundle, you are buying all of them and paying a higher revenue. This company is collecting more revenue than if you were just picking one. So to me, that discount, it helps out in the long term. We see this company, this balance sheet, and is okay to me. It's not really that great. I would have expected this company to have a way better balance sheet than it really has. One thing that really trips me out is seeing that low cash compared to the long-term borrowing. Like I said, most giants that I've seen usually have higher cash than long-term borrowing. But like I said, right, this company has needed to buy huge lands to run its theme parks. We see that huge, like I said, that revenue growth in every type of segment, from theme parks to movies to everything else. One thing that it is something to be worried is this quarter, coronavirus happening in Asia. We're definitely going to see a lot less revenue coming from the international. We're going to see that slowdown continue to happen throughout the upcoming quarter. So that's something that will definitely hurt. Hopefully Disney Plus expenses are not going to be that much heavier next quarter, which will help bring the net income and cash flow provided by this company. Also, another thing we saw is this company has a pretty low PE ratio compared to other giants, a 23 forward PE ratio. I think it's definitely okay for someone to open up a small position in Disney. I already have position in Disney, so I wouldn't add at this point. To me, it's not cheap enough to add to an existing positions. But if I had no position, I would definitely buy a small position. So yeah, let me know what you guys think. Have a good night and see you next time.